Good day, traders. Stacey Burke from Stacey Burke Trading. Today, we're going to review mastering price and time. I received quite a few questions, emails regarding the discussion yesterday on the gold trade with the 100 pip boxes. Why I took that trade. It was an inside day. It was this, it was that. And we're going to review some concepts again regarding the three things that markets do. They break out, they pull back, and they trend. They break out, they pull back and reverse, false break reversals, or they trade sideways between a high and a low in the trading range. That's all they do. That's the only three things that markets do. I've talked about mastering the 100 pip box and understanding that 25 to 50 pips outside of those areas can be false breaks or a peak formation locking in the highs or lows, and it all comes back to the timing of when everything happens. I focus on the equity hour. If there's a trade that comes prior to that, then I'll take the trade, because the equity hour can be the blow off or the capitulation of that move, trapping traders further into the move when the session opens. But mastering the concepts of pump and dump, trap traders, three levels of rise and fall, and using the 100 pip box to understand this, instead of focusing on little price movements back and forth and candle action, use price and time. That way, when people say, well, that's hindsight or anything else, my first question is can you tell time? My second question is can you tell what a 100 pip box looks like? People ask me, well, where do you put your 100 pip box? The 100 pip box is price. Whether it's $1, whether it's $10, irrespective of the instrument, price is price. I didn't put that on the chart. It is what it is. And if you understand and master that, your thesis can become a lot more rock solid in terms of your confidence to enter a position and understanding that you have a high or low locked in, or you're trading with the trend, or you're in a reversal situation, whatever that may be. So if we just scroll through a few pairs, go and study any instrument, regardless. Understand the movement that occurred. Doesn't mean that it had to be a best trade setup or that you had to trade it, but you can understand that they can be traded in either direction, regardless if it's an uptrend or downtrend. And then you need to decide, well, what are your best executed trade setups, and focus on those. So on the US Swiss, we had a strong uptrend day, but even so, when we get to New York, we start the move in that first few hours at the quarter level. So we're 25 pips above the double zeros. So when you see price up inside of a box 25 pips above, there's space underneath where they are already getting traders to buy in the upper part of the box. They've lifted at 25 before they even start the move. That's your first clue. Now, people have asked, why did you add an extra hour in? I just added an extra hour in. It doesn't change anything. It means nothing. I'll change it back. It's irrelevant. The time is the time. In the US session, when New York opens at the same time. If you take a trade earlier in the session, you're taking a trade earlier in the session. It's irrelevant. So the market accelerates and lifts up to 50 and continues to go vertical. When we get markets accelerating and lifting, that can potentially become low-hanging fruit later for a vertical move back in the other direction. So we've now come up 25, and we've come up another 25 to 50, and now they're going vertical up to 75. When the New York session opens, they take out the high of the day. We have one push, two pushes, and three pushes, and a 1, 2, 3 at the very high. If you're not sure what that is, go study the charts. This is level 3. We're at 75. That's 3 levels of rise. Now, timing-wise, we're 45 minutes into that second hour, 15 minutes past the New York Open. We have a 1, 2, 3, and an engulfment. Whenever I'm looking to enter the market, once I have my thesis confirmed, if I'm looking to short this, I might have been long, but then I'm looking to short this. I'm focused on the price level. I am not worried about the candles. I'm not, what is it, which one should I get in? Which one? I'm getting in at the price. 75 plus the spread if I can get it. If I can't get it, I'm just getting in. My stop loss will go here. That's the upper port. That's the high of the day. If it goes back another quarter level, I'm wrong. But if my thesis is that I'm selling this, and I'm not saying that this is a best trade setup, I'm just giving you price and time regardless of the instrument. We've gone up to the third level, New York Open, we've accelerated the move, 3 pushes, 45 minutes in, the high is locked in, I want to get filled at the price level. Stop goes there, vertical drop straight away. Break in structure, all of these traders are hit. If I'm going to either exit this trade or look for a short now, I want to sell the pop-ups above the high of the day, the peak formations, and the same thesis applies. Once I'm in this market, my stop will never exceed 15 to 20 pips. It should not go back up into that upper quarter level. The market then returns down slowly and auctions back to the low of the session before locking in the low and pulling back. Now again, I'm emphasizing mastering price and time. We can look at the Japanese yen. The market in the pre-market goes 25 pips above the 100 pip box before coming down and putting a peak formation in underneath. That means there are stops above at that quarter level. When New York opens, they are going vertical through that high of the day, high of the session. The high of the day is up here. We're 25 pips above the 00 box. False breaks or marginal new highs or lows will be 25 to 50 pips. Timing wise though, New York Open, we're 25 pips above the 00s. They break down and come back up into that level before trading sideways and locking in the high. Once they break down underneath and they pop back up, this right here, this pop-up, locks in that high of the day at the quarter level. If you were shorting this, anywhere underneath, once it pulls back, is an executable trade setup. Stop goes above the high of the day. Timing-wise, New York locks in the high of the day. They break structure and trade back up into that. Hit stops, consolidation sideways, and break down. They go back to the low of the session. And again, emphasizing, I am not suggesting this is a best trade setup, but price and time, you need to understand the 25 pip boxes outside of and below the 100 pip box. We can look at the euro. Consolidating sideways above the high of the day. Whenever you see a market consolidating without taking out the high or the low of the day and it's sideways, it is going to explode. This space above the highs between the numbers, the quarter level, and the highs of that session is a dead giveaway. They're going to come back. They're getting traders to sell it lower and lower for the continuation of that trend trade. And when they come back up through there, it will be an explosive move. They go 25 pips outside of the 100 pip box through the low of the day. New York opens and extends that range down for 45 minutes of the hour. 15 minutes after the New York session. False move for 15 minutes in the continued direction of the trend. They engulf the low at 50. Pull back inside. Trade back into that breakout and pull back. This is what I refer to as a zero box, a day zero setup, whether it's on a 15-minute time frame, a daily time frame. We see this at the beginning and the ends of months. They consolidate sideways inside of a rectangle. This is a short squeeze for a reversal and a trend trade back up. Zero box consolidation, the tighter squeeze down low, the explosive breakout, and the reversal, and then the explosion back through the space on the traders who were short. So if you didn't take any money off the table, they came back and got you. You're holding on here, consolidate, bang, the reversal, and the explosion back up. 25 to 50 pips outside of the 100 pip box. Previous day's low of day essentially is the 100 pip box. We can look at the British pound. They break through the previous low of day. That triggers breakout traders. We are at the quarter level above the 100 pip increment. They gradually creep back up into the peak formation at 50 before breaking down and consolidating and breaking down towards the low of the day. Again, there's space between these lows and the numbers. That's a dead giveaway. This is not a low peak formation, low of the day formation. This market continues to auction lower. New York hasn't even opened yet. So again, not counter trending the peak formations. People say, well, you're at the low of the day. I might be, but it's a trend trade. If you're going to enter this market, this is still a trending market. New York opens up and takes traders 25 plus pips in further into the trend before engulfing 45 minutes into the session. So again, time compression. The next 15-minute bar begins the reversal. And they get traders trading back into that peak formation low, consolidating sideways before exploding out and coming back up to get traders who were short at the beginning of the session. Gold, same thing. I had traders messaging me telling me they were, looking for the reversal and different things. I'm not trying to predict. I am just coming to this session and looking at where we're at and then watching how price behaves. I'm not going to, try to forecast. I just want to trade whether or not there's a setup. If there's a setup, I'm going to trade it. The peak formations were up into 50, into the lower peak formation on the way down. We had the previous low of the day just below us. And we'll talk about that in a second. Peak formations are up into 50. They're locking in the high. Peak formations are up. Trap volume between 25 and 50. 1 hour sideways. 45 minutes to 1 hour sideways. This is a tradable market. The high is locked in. The market continues to break down into the new 100 pip box. Peak formations are up into double zeros before breaking down again to 50. Peak formations are up into the third level. This is shortable again. Breaking lower. Peak formation. New York Open, pin into 75, just above 50. This is a 50 pip blow off. It extends 25 pips below the range before coming back vertical into the breakout of the previous day's low. So we have breakout traders in the market, we have trend traders in the market, we have New York Open traders in the market. They creep this back into the low, peak formation low, before locking in the double zeros and beginning the auction process back up. Again, timing-wise, this market reverses, starts the new hour back in the other direction. Oil, same sort of understanding. They come down to a 100 pip box when the pre-market begins. The auction process starts to come up for 3 levels. It breaks 25 pips above the range. This is West Texas. For breaking down and coming back up into that peak formation. So we have 1 level of rise, 2 level of rises. We're in a 100 pip box. They push a third time in a 1, 2, 3, 25 pips above that 100 pip box before breaking down at the end of the hour. That space between 50 and 0 with this low-hanging fruit. So again, when price is ramping, this potentially becomes an area for a vertical move. Market continues to break down into a new 100 pip box, breaking down again, creeping back up into the third level, and breaking down again through into the next 100 pip box, breaks the previous day's low. We have breakout traders in the market now, other time frame traders, consolidating sideways peak formations into 75 at the New York Open. We're in a new 100 pip box. So irrespective of everything above this, I want to be selling in the upper portion of the 100 pip box if price and time dictate that. The market blows off and continues to move into the new 100 pip box before breaking 25 to 50 pips below that box and pulling back inside. 45 minutes into that second hour, 15 minutes after the New York Open, before pulling back inside the 100 pip box and auctioning back and forth inside and reversing. So again, 25 to 50 pips outside of the range. If you're trading just the New York session itself, you're inside of a 100 pip box. They pull it up into the third level. This is on a 15-minute chart. Sorry, a 1-minute chart. So this third level, peak formation, in a downtrend, again, do not counter trend the peak formation. The peak formation then gets put in below 25 to 50 pips below the 100 pip box before pulling back inside. So again, just going over the gold trade from yesterday. We'll look at the first chart. So traders said it was an inside day. Why were you trading it? Breakout traders are triggered right at the end of the previous day. Markets do three things. They break out, they pull back, and they trend. They break out, they pull back, and they reverse, or they trade back and forth between a high and a low in a trading range. You've heard me emphasize this before. Do not counter trend a peak formation. This, to me, is a trend trade back in the direction of the original creeping, broken trend. So when people are confused and they're inside, it's because you're only focusing on the idea that you can only work from the extremes. The extreme was already tapped. They got breakout traders in the market. They've hit stops, whatever that thesis is, but they've locked in the high. They've locked in the high. This market's continuing to fall. I do not want to counter trend this market. But scaling down to our smaller time frame, Asia put a low in place. They broke 25 pips above the 100 pip box before putting in a triple top, a head and shoulders, a ghost and mittens, whatever you want to call it. Prior to our Europe window, they came back inside of the 100 pip box and put in a peak formation high. First target's going to be the low of the day. It breaks down and pulls back above 75. That's our upper level in the 100 pip box. They lock in a low. They're trapping volume above the low without hitting it. When you see a consolidation above a low or below a high, they're building up energy for an explosive move. M pattern, engulfment, short. It's a 1 bar stop. We're in the upper quarter. They break out and pull it back in 3 pushes to 50, peak formation. Another entry. It breaks down, London opens, and takes traders another 25 to 50 pips into the new box. So price and time. Critical to understand and master the 100 pip box. The peak formations in London were up into the double zeros at this stage. No indication of a break in trend. We have our half Batman formation into the double zeros during the London session. But coming back to simple concepts, this is a pump and dump. Pump it up, lock in the high, consolidate, build up volume, continue the trend. So you have to understand what you're looking for. It doesn't matter what instrument you trade. You can use and master that 100 pip box and then the timing of everything. 15-minute rotations, 45 minutes into a new hour, 25 to 50 pips above or below those ranges. Equity market opening times. Critical to understand that getting filled at best price at the price level, not chasing the candles. Once you have your thesis confirmed, it's about the price. So hopefully you got value from that today, traders. Master price and time, 100 pip boxes, the timings, the pattern of the trend, understand what you're looking for, execute your best trading setups, and may the markets go with you.